Treasurer Jim Chalmers has just released his budget, and I'm going to take you through some of the key takeaways and where you might benefit from some of the announcements. Now, I do apologise, this video is a little rushed as I wanted to get it out to you as soon as possible. Let's first talk about some individual tax cuts. From 1 July 2027, there'll be a new tax offset available called the Wato, Working Australian Tax Offset. What this will be is a $250 tax offset available to all working Australians. So if you're on the age pension or if you're on welfare, you'll be excluded from that tax offset. Now, you won't see the benefit of this until around July 2028 once you lodge your tax return. Now, this is starting in the same year as the $1,000 instant tax deduction is starting. That's not a new announcement, but it's starting at the same time. And that $1,000 instant tax deduction, you won't get that in the hand, just to clarify. That will just reduce your taxable income and reduce your tax bill a little bit. So the Wato is a newly introduced tax offset. The Medicare levy threshold, which is the income where the Medicare levy starts to kick in, those rates have increased for singles, for families, and for pensioners. Now, whenever that threshold increases, it pushes back the point at which you need to start paying it, which means you just pay tax a little bit later. So an increase in that threshold is really good for everyone. Now, the big ones, and these ones you really need a good accountant for. The first is changes in the capital gains tax discount, CGT discount. And this is changes for both property and for when you invest in shares. And simply what we are transitioning to is moving from a discount capital gain system to an indexation system. How the discount system works is, say you bought a property for $100, you held it for a year, and then you sold it for $200, you've effectively made a $100 taxable profit. Under the CGT discount rules, you would only pay tax on about half of that. So you only pay tax on $50 even though you've made a profit of $100. And that's called the 50% CGT discount. What the indexation method looks like is on that same $100 that you've made, you would then reduce that by inflation over the years that you've held the investment. The calculation is a little bit more complex. You might need a good accountant for that one, but that's what we're transitioning to. Now, when the rules take effect is the tricky part. So for existing built properties that are sold prior to 1 July 2027, you will still have access to the 50% CGT discount. For existing properties that are sold after 1 July 2027, your tax gain will be calculated using a combination of the two systems, with a minimum of a 30% tax being applied on the indexation part of the calculation. So really important to speak to an accountant here, as you may need to get a valuation completed at 1 July 2027. Now, this is the main part of the policy. For any new builds, any new residential builds, you will have the choice of the 50% discount method or the indexation method, with the idea that this policy is trying to promote new built houses, promote housing supply. And for old builds that are purchased after 1 July 2027, you will be in the new tax system of indexation. So what's clear here is you need a good accountant. Second part of the big rule, changes to negative gearing. Negative gearing occurs basically when the income you make from a property is not enough to cover the expenses related to that property, and then you can reduce your personal tax bill by whatever that loss is. That's effectively what negative gearing does. Now, again, there's some really complex transitional rules which we'll go through. And what we're eventually transitioning to is that negative gearing will only be available for newly built investment properties, again, contributing to that housing supply. So for investment properties that are held before budget night, 12 May 2026, that are already negatively geared, you will not be impacted. You can keep this negative gearing benefit right up to when you sell the property. For existing investment properties purchased after budget announcement, they can be negatively geared until 30 June 2027. And then from 1 July 2027, you will lose that negative gearing benefit. And for investment properties that are new builds, you still have the option to be negatively geared. Now, perhaps some of these tax concessions were a little bit too generous. However, what bothers me is that these changes have been framed around as going to solve the housing crisis. It's going to help young people be able to buy a house sooner.
Because the interaction of the housing market and the tax system is locking too many Australians, particularly young Australians, out.
Can you rule out any changes to negative gearing and capital gains tax?
Yes. How hard is it for the 50th time?
And why that might help a tiny little bit, I don't think it's going to help nearly as much as what the politicians are indicating. The main cause of our housing crisis is a lack of supply. We've had a lack of supply for the last 20 years. In my mind, this is just a little bit of a tax grab, but hey, that's where we are. The way trusts will be taxed are changing. Effectively, on distributions, they're going to be taxed at 30%, which is bringing them in line with how companies are effectively taxed. If you hold a trust as a small business owner, this would be a good one to speak to your accountant on, making sure you have the correct investment vehicle. There still remains a ban on foreign investors from purchasing Australian homes, which I think is really good. It was originally a 2-year measure that started in 2025 and was due to expire in 2027, but this has now been extended out to 2029. There's going to be more money put into public hospitals, about $25 billion, and more money put into the pharmaceutical benefit scheme, meaning more drugs will be put in that scheme, making them more affordable for Australians. So that can be good as well. With the war in Iran and all the fuel shortages we've had, we're going to invest around $10 billion in locking up fuel security for Australia, which probably should have been done many years ago. And for small businesses, the introduction of these loss carryback rules. And what that means is if you pay tax as a small business in year 1, and then the second year you don't pay any tax because your business makes a loss, you can carry back that loss to claim the tax that you already paid. So that's really good for small business owners that are perhaps struggling with a bit of cash flow and your profits are up and down while you're starting up. And cuts of about $36 billion to the NDIS, which was really starting to balloon out of control. Let me know in the comments below what you think about the budget, what works for you, what doesn't. And if you enjoy watching finance content, make sure you check out these next videos.